good afternoon, good morning to wherever you are in the world. Thank you for joining myself, Elliot Rowe, and Richard Bradstock, both of the RPA group. Richard, the MD, and I, one of the associate directors based here in the Middle East. As I'm sure many of you are aware, we sort of running these sort of webinars on a monthly basis now for the last 6 months or so, and thought it was quite a timely point really to, sort of deeply into the third quarter, the fourth quarter of the year, and now just to sort of discuss where we see the market, where we're seeing the opportunities, and also sort of an update on sort of the RPA group and sort of current projects and everything else along those lines. So Richard and I will talk you through all those points, and hopefully you find it very informative.
It's hoping, yeah, absolutely. Okay. Also, just to mention, we'll be talking, we're guilty sometimes of saying the markets and referring to the UK, but we are going to be talking a little bit about Germany and Berlin today as well, of course.
Exactly. And actually, that's a sort of a good point to start off with, really. So for our sort of our valued customers, many of you will be aware that sort of everything we talk about up to this point has been UK based, but we are a real estate investment firm that look at sort of opportunities throughout the world, really. Mainly it's been UK focused to date, and therefore over the last 3 or 4 months we have taken on a new project in Germany, in Berlin, and so that's just from our perspective, and what we're trying to do and trying to achieve is offer our clients the best real estate investment opportunities that we can find. UK and Europe now very much a focus for ourselves. Richard has vast experience in the sort of Germany market, so can maybe just sort of shed a bit of light on why we've sort of just as a brief overview, and we'll go into detail about it shortly.
Very good. Sorry, did you want a brief overview now?
Yeah.
Yeah. Sorry, I misheard you. Yeah, I think, as you said, Elliot, what we're trying to do as a business is offer our clients, our buyers, the right advice and the right access to products. And hitherto, it's obviously been UK focused. We're very proud of what we've done there and the projects we're involved with. Obviously, the pound, is perhaps not for everyone. You might not want to put money into pounds. You might already have an extensive UK property portfolio. You might, for whatever reason, feel that it's not the right time for you to go into the UK. And so one of the things that we are trying to do is broaden our offering. And as Elliot says, I've got a lot of experience in the German property market, and it made sense that this should be our next offering to our clients. And we'll actually be those of you who receive our emails will be receiving something on that this week. We're sort of bringing it to market officially this week. But for all the reasons that Germany, or that the people like buying in the UK, the stability and safety and so on, it's the same for Germany. It offers a very similar sort of argument, and we'll delve into that in a minute in a little bit more detail. But I'll move the slide on, Elliot, and perhaps you can talk a little bit about the UK initially. Yeah,
look, so with regards to the UK and where we're up to at the moment, we have since a year ago, we've had 12 months since the mini budget of seeing obviously interest rates increase dramatically. There's been a lot of discussion around the UK housing market and how that will be affected. I think that the most important thing with hindsight really is the robustness of the housing market itself. We see economic challenges. Using 2009 again as an example, we see economic challenges that sort of hit all aspects of the economy, and yet the housing market stays resilient, with the sort of key underlying factors of the demand levels being there, and then also from a pricing perspective, with the general wealth within the UK. if people don't need to sell, they won't, and so therefore the demand is always there, and therefore there's less property available in the market. Quite simply, your prices will at least sort of, you won't ever see a dramatic fall off in pricing. And a point I've made here within this, sort of since the peak, so we've seen a sort of 20% increase in house prices, sort of from 2020 to now. But actually, and then even if we have a 7% decline this year, which depending on what you read, it varies from anything from 2% to 7%. But even if we did have that, we'll still be, the market is still, as I'm saying here, it's 6.7% higher than it was in 2020. And so it's still the market is still strong. As long as you're holding the properties that you're purchasing for a period of time, an absolute minimum of sort of 5 years, I would always suggest 10 to 15 years. With the way the housing market acts and reacts, you do. You'd be incredibly unfortunate to ever lose money or make it even a bad investment. I mean, another example is 43 out of the last 50 years have seen positive house price growth in the UK. These are the sort of things that are going to continue.
I mean, if I may jump in, like what's you're absolutely right, and actually what's particularly interesting at the moment, because we've been running these webinars obviously over the course of the year, and actually our message throughout has been exactly broadly what you've just said, that anybody buying property in the UK, anybody owning property, there is zero need to panic. There's plenty of good stuff still happening. We'll talk about rents in a second. But what's particularly interesting in the last month or two, since we ran our last webinar update, which was in September, is that actually there's a bit more good news around. There's a bit more, it feels like there's a bit more stability than there was perhaps, say, in the first sort of Q1 or first quarter or two of this year. So I think, month on month transactions in October were up, we're up, or September was up over August and expected to be up in October again over September.
Yeah.
So this is people returning to market, and actually, returning to the market as buyers, I should say. And whilst we're still lower than clearly we were, say, 18 months ago, it's moving in the right direction. And I think part of that is, that the base rate didn't move up again in September from August, so there's a bit of stability there. And just, that we've got we've been talking about this all year, but haven't we? But we've got the first signs of banks really coming to the market into, having a bit of a price war from a mortgage perspective, because banks need to lend money. And just as a sort of personal example of that, I have a property in London, and I was on a tracker rate, and it had gone all the way up to just over 8%, thanks to the base rate rising. And HSBC had said, no, I'd asked them about whether we could refinance, remortgage. And they'd said, no, the rates we can offer you are basically the same as the rates you're on. Until last week, where I suddenly got an email from them saying, actually, we can offer you a much better rate. So I managed to switch, and now I'm on 5.79 as opposed to being on 8, and that translates to sort of £600-700 a month. So it's a significant saving. Yeah. And I think what we're seeing here, that's just it's a personal example, but an example of what we're starting to see in the market, because banks, HSBC in this case, have realised that actually I might go somewhere else, or people on these high rates might go somewhere else now because other banks are offering cheaper rates. And so all of this provides a level of confidence and a level of stability and opportunity that perhaps hasn't been there earlier this year, for example.
Exactly. And we are coming out of an era of incredibly low interest rates. But if we look back to 1997 to 2023, the average interest rate across that time period works out, I think, at 5.2% interest rate. So across that, but obviously we had a number of those years have been significantly lower. So we're coming back down towards a bit more of what you may
An
call
average.
normality.
Yeah.
And again, that just gives people confidence, and ultimately people do need to buy. The final bit, really, just on the UK from our perspective, is the while house prices are sort of the plateauing or slightly dropping down, we're probably what that does mean is that the rental are increasing dramatically. So you're seeing in the last sort of particular areas, you're looking at sort of 20 to 25% rental increases, and over a sort of a 12-18 month period. And obviously that, with a lot of the properties and a lot of our clients, these people are looking purely on an investment perspective, and ultimately what they want is tenants in those properties and looking to achieve rent, which is increasing. So with that, if there are less buyers in the market, then there will be more renters, and therefore there will be again a higher demand pushing up prices.
It's sort of it can be a little bit counterintuitive. You think, cost of living and so on is rising in the UK, that people will be trying to pay less rent. But in actual fact, because there are less, as you say, less buyers in the market, they're being forced to pay more rent. We'll come back to this in a minute, right? But when we're talking about some of the product, but what this translates to is rental yields in London, for example, pushing 6%, even higher, which quite frankly was unheard of even 18 months ago. So there is opportunity. I think, and obviously we are a property sales company. We have an inherent belief in the market as a result of that. But I think just, and I'll probably, between us, we'll probably say this several times over the course of the next 20-30 minutes, but I genuinely feel that there is such an opportunity now. If you're an overseas buyer, or any buyer with some cash, with the ability to actually go and spend money, invest money into the property market, whether that's London or other locations, there is an opportunity now to access product and developments that previously, as an overseas buyer, it would have been difficult to access because locally they would have been snapped up. It's also, developers are being a little bit more open to deals, to little incentives, and you've got the rental market, as Elliot's just said, that's absolutely booming. So if you're in that position where you can invest, now is the time. It really is. Now is the time when there aren't that many domestic transactions, so there aren't that many local buyers out there, which means that as an overseas buyer with a cheap pound, perhaps you're based in a dollar-based currency like the dirham where we are here in the UAE, there's a real opportunity to actually put money into the UK, make it work for you, and at a point in the market where all the sort of indicators from mortgage rates and so on coming down suggest that at some point in the next 6-12 months the market will start moving again. And so if you can buy now, there's an opportunity to do so at a better rate than I would expect you to be able to do in 12 months' time. That's or access product that you might not be able to access. But we'll probably say that once or twice more in this presentation. That's very much the thought process, isn't it, Elliot?
Correct.
So just so you probably to all of you on this call, you probably haven't heard us talk about Germany and Berlin much, and we will be running a sort of a very detailed, focused Berlin session in the coming weeks with the launch of the new development that we are coming to market with this week. In many ways, Germany and Berlin is going through a similar sort of process that UK and London has, albeit on a slightly sort of lower level. The prices have come off a little bit over the last 12-18 months as inflationary pressures have bitten. What's quite interesting about Germany and Berlin right now is that they have actually weathered that inflationary storm much better than the UK have. So inflation rates are already dipping significantly. They're lower than the UK. What this has meant is that the European base rate, bank base rate, hasn't gone up to the same levels as the UK. So rather than an interest rate of, you know, probably 6% plus at the moment in the UK, you are looking at more like 4.5% in Germany, and that's possible to fix that over a, you know, 5, 10, 20-year period. So that's quite interesting in its own right. Berlin also, for those of you that are unfamiliar, it's a market that, because of its history, it's really sort of unique history in terms of it, you know, being split during the Cold War, the Berlin Wall, having heavy, you know, Russian presence in the east, which was less wealthy. Berlin was a capital city of Germany, but without being sort of recognized as such through real estate values and so on. Frankfurt, Munich, Hamburg, you know, these are all cities that even today are more expensive to buy real estate in than Berlin. But Berlin, over the last 20, 30 years, has blossomed, and it's now the biggest city in Germany, almost 4 million people, the population rapidly increasing. It's got a fundamental undersupply of property, and property is still cheap. It's still significantly cheaper than comparable cities in other European locations like Paris
and Germany itself.
And Germany itself, yeah. It's a bit like, I was say, it's a bit like having Edinburgh being more expensive than London. You know, there's, you know, in the long term, there is no logical reason why that will be the case. You know, Berlin will overtake and become the most expensive city in Germany over the next sort of 10, 20, 30 years. Germany, of course, is renowned for its sort of, you know, its industry and commerce. You've got major businesses. Berlin, for example, is now the home to, or will be the home to, Tesla's first gigafactories, I think they call it, in Europe. You know, so a lot going on. And thanks to real estate legislation, it's very difficult to build, and secondly, it's very difficult. It really only makes sense to buy new build property, and because it's so difficult to build, it's such a small market that you know, we've got some very significant price increases predicted over the next 5, 10, you know, 15 years. Anyone that is German and from Berlin on this call will probably be thinking, oh, you know, I remember even 10 years ago it felt cheap, and it was, but it was too cheap, and that's the point. And even today, you can see projections there on this slide for, you know, significant capital value increases, 63% rise in rents for new build property over the next 5 years. And you know, it really is. There's a reason why PwC, for example, have had it in the top 2 or 3 investment destinations for the last 10 years straight, and it still sits there today, with London, interestingly, being in there.
And a crucial point when, you know, obviously we're talking to you all as investors, which I think is sometimes slightly overlooked, but also in comparison to the UK, 75% of the population of Berlin are tenants. They rent. So as an investor and purchasing property there, you have an immediately larger pool of business, essentially.
Yeah, and that's, you see the vacancy rate there, 0.8%. That's what then translates. Whereas the equivalent vacancy rate in somewhere like London is just over 2%. So yeah, very, very strong story. Good interest rates, good, you know, good growth projections, you know, good developers, good stock. But a couple of key things there. So we've already talked about the mortgage rates, but one massive thing which Germany has that most other places don't, almost around the world even, is that if you own property for 10 years and then sell it, there is no capital gains tax in Germany. And so this obviously can significantly increase returns over that longer term. So yeah, it's you know, quite an interesting piece that you don't get in the UK, for example. You don't get in France, you don't get in other European locations. One of the, I'll sort of ask you this question, Elliot, but one of the things that's very much on vogue at the moment, you know, if you're interested in property and you probably subscribe to other companies, adverts and all the rest of it, and you see them on Facebook and all the rest of it, one of the things that is talked about all the time is short lets. So obviously the appeal for that, right, is higher income. And we're going back to the UK. I should say this is now moving back away from Germany. But John, perhaps you want to talk a little bit about short lets and what you need to look out for, Elliot. I think that would be quite useful.
Yeah, absolutely. I mean, look, I think at the again, going back to sort of how we opened up the conversations here about sort of the higher interest rates, and us as an investment business looking for the best opportunities for our clients, we have very much delved into looking at the short let options and the benefits that can provide when purchasing in the sort of right locations, right with the right demand, and actually ultimately what that will achieve you as the investor. And you know, if you're at the moment sort of looking at a 2-3 year fixed rate and that side of things, then with a slightly higher interest rate, then potentially looking at an apartment block where short lets are allowed and there is a demand for it, it is a very viable option to make sure to ensure that you're continuing to get a fantastic return.
What are the things though to look out for on, you know, because you've just touched on the right location. We see short lets advertised in all sorts of weird and wonderful places across the UK where quite frankly I would be skeptical on whether there's a real genuine demand for that. So what's your views on that side of things?
So, I mean, in terms of sort of location, in terms of why and the right sort of, you're going to have each element of the pieces of the jigsaw sort of to make sure it does work. And, you know, when you're looking at areas that are sort of up there in sort of top 5 visited places from a tourism perspective within the UK, when you know that there is a pool of business like teaching colleges or universities or anything along those lines that can be the type that use short lets, or businesses that include people that so international businesses that have people that travel, and so we're going to be using like essentially looking for hotel rooms, but there isn't, or in a location where there is a severe lack of hotels, and so the Airbnb short let option is something that is quite needed quite strongly for local businesses. So there sort of lots of smaller points. It's all down to the demand. What is the demand in that area for a short let? Whether if it's
I mean, you're absolutely, sorry to interrupt. I think you're absolutely right. The other thing I think is, you know, I think one of the things we had on the flyer, albeit it's not on the thing here, is sort of where to, you know, something along the lines of where to be careful. When we bring a product to market, the idea clearly is that we've done all the, you know, we've done all the DD, we've done all there is, all the background checks, we know that everything there is to know about these products. What I think you have to be careful in the short let market is not only the location and making sure that there is demand, but you do see some pretty serious promises out there. You know, high net yields guaranteed, things like this, where and on product often that is off plan and not built and no track records, you know, there's no guarantee. So you've got to ask yourself, who's guaranteeing that, and is it really going to work? And so obviously we're going to talk a little bit about one of our products in a minute, where we've done that. But and the other thing, of course, is that you have to be, you know, for example, short letting in London is actually essentially banned after, you know, you can do it for 90 days of a year. And after that, you have to have a specific license for it, and most properties will not have that license. The way that councils around the country are managing, you know, we every now and again, I'm sure you will have read, this council has banned short lets or banned Airbnb or whatever it might be. they're regulating that through the essentially the planning permission that property holds, the license that property holds. And if it doesn't have, if it's designated as a private residence, which most of these things are, in theory, you could lose the rights to to let it on a short-term basis in a legal perspective. So something that we are, something that we've just brought to market, because people are at the moment, for obvious reasons, interested in income. We've brought a product to market in Leeds, which you can see. Actually, I'll move on to the next slide, where this is a built and oh, sorry, I've gone too far. My apologies. I don't think it moved. This is a built and functioning development, and with a track record. We're offering a 6% net rental guarantee for 6 years, but in actual fact, the actual net yields being achieved are almost 8%. So, which is why the developer is able to guarantee these units at these levels. So this is fully functioning with a full track record, and it's the sort of thing, if you're interested in this space, that we would obviously suggest you have a look at.
And as Richard sort of pointed out earlier, when we're talking about predicting, certainly when you see opportunities like this that can be off plan, they're based on predictions and everything else like that. This is physically built and running as a short-let business, short-let business.
It does mean there's no mortgages on this.
Yeah,
this is a cash purchase, but
the other thing is, we know, for instance, that the occupancy rate is at 92% this month, and it has been running at 8.
Just on that, Elliot, sorry, I had a message from the developer yesterday saying we're now at 99% for November. So it's
So that these are the sort of key bits of information that you need to sort of be aware of, and to give you that full confidence when investing in something like this, to ensure that there is a good track record, or there is evidence to back up the guarantees, and ultimately to ensure that it's the right investment for you. But those sort of little key bits about occupancies, the type of tenants that are using it, and all those sort of things are what we've got to look into to ensure that it's the right investment for you.
I mean, do you again?
I mean, slightly different sort of angle, really, in terms of the short-let business. But this is a project of ours done in Hove, in Brighton, so sort of the affluent suburb of Brighton. A chronic undersupply of property within the general area. Chronic undersupply of apartments and flats within the local area. It's sort of surrounded by traditional Victorian terrace streets. Average house price probably, and it is a house. Average house prices of north of 850,000. There is an incredibly strong demand within the area for short-let hotels, even, and there is a complete undersupply of this. This particular project is a 5-minute walk from Hove train station and a 10-minute walk to the beach. So with all these sort of attributes sort of put in mind, and then when you consider that Brighton is the third most popular place to visit in the UK from a tourism perspective. Yeah, exactly. From a tourism perspective, all these sort of adding up, and then you're looking into why this makes sense from a short-let. So it's slightly different with this particular project and its location as well, and the general demand in the area. It already has a fantastic rental yield option. Excuse me. A fantastic rental option on an AST, which is an assured short hold tenancies, which is a typical tenancy agreement of 12 months. You're still looking at sort of north of 6% on that. But the short-lets is an incredibly viable option, which we're quite excited about with this project. Yeah, because it's Brighton, exactly.
Yeah, exactly.
But they're two slightly different angles. Sorry, and the point I was going to make with this is that also from an exit perspective, because of the lack of apartments within this particular area and that side of things, we can see the capital appreciation being quite significant with this, considering the affluent suburb that it's based in. So putting those two combinations together really does put for a good investment case.
Yeah, Brighton is one of those. Brighton is a location that if you're moving, it's the most moved to town from London. You know, so if you're based in London looking to get a bit of more, I suppose, smaller town, countryside, seaside living, people move to Brighton. And yeah, it's been very popular. I mean, so moving on to London, there was actually an article yesterday, wasn't there, or the other day, commenting for those. It's quite interesting, particularly for those investors of ours who are Middle East based. But it's always been a city that Middle Eastern based investors have bought, but particularly at the moment, it's now becoming again even more popular. The amount of money that's predicted to come out of Saudi, for example, out of the Middle East generally is enormous over the next sort of 12 months or so. And again,
and I think with this headline sort of comment and figures and things, is that London is London, as the saying goes. But London now is genuinely good value. So, and the reason that I say that is if you house prices in the UK have risen by 35% since 2018.
60.
But then in London, they're only risen by 12%. And that's why we're starting to see that's why you're starting to see much stronger yields. You know, we've got projects with yields that are sort of north of 6% or at 6%. And because the rents have increased, but the values haven't. And people are starting to capitalize on this. Now, the PCL, Prime Central London, has seen an extreme tick up in foreign investors purchasing property in its sort of prime locations. What happens with London, and I think 2010, 11, 12 is a prime example of this. When it becomes good value again, or there hasn't been significant house price rises, or there's even been a house price drop, like we saw a significant one in 2008. Investors start to see the opportunity there, and then sort of start to flood in. And we're seeing that now. When it starts, it's like the ripple effect with London. So you'll see Prime Central London will be the first to go. Investors looking at the higher ticket opportunities, and then that ripples out throughout, to be honest, the rest of the country. So you're seeing that now in London. 12 months time, it's in the rest of the country, but it will slowly move out through the zones. And so now is the opportunity to buy before we start seeing that tick up in prices.
It will only take, it will take mortgages to drop down consistently, below 5%, and then suddenly it will, suddenly things will move, and that is likely to happen sooner. In fact, I noticed when I was doing my HSBC remortgage, if I was based in the UK, I could have actually got a rate at 4.8%, 4.79%.
Yeah, so, exactly.
It's which is the first time we've really seen those rates come back to those sort of levels.
Exactly, and that will start with the home market, with your home buyers and people living in the UK, and it will start to knock into the overseas investors that have always been a bit higher than the local market when it comes to interest rates.
I think so. Just in terms of general advice and strategies, there is an opportunity now to go and get a little bit of a deal in inverted commas, to get, developers are willing to sort of talk about price a bit more than they were, say, 18 months ago. And they need the overseas market today in a way that they didn't 18 months ago. And so from that perspective, there is this opportunity, but it won't last. It won't last forever. So if you've got the ability to, secure something with a deposit of 10 or 20% today, with a completion date of late 24 or 25, where by that point we would expect the interest rates to have come down. to be a much better, and the market should be moving. By that point, we would expect, domestically transactions to have picked up dramatically. One thing, Elliot, I know you and I are very, perhaps predictably, given the jobs we do, but very bullish on this stuff. We've seen so many ups. Well, I say we've seen many ups over the past sort of 20 years of working in the UK property market. We've seen a little bit of down here or there, but not much, and throughout all these sort of problems, whether it's COVID or the GFC in 2008 or Brexit, in the end, the UK market carries on. So I think if you can secure something today, that will stand you in good stead for a year or two's time. So as ever, you've got to buy the right product, and that's hopefully where we come into it. At this point,
we're just seamlessly moving into our RPA product portfolio.
So shall I start with Berlin then, just quickly?
Yeah.
So we are launching this week a development called Spreetel Living in Siemensstadt. Please forgive any pronunciation errors on my part there. I never did German at school. But this, it basically translates to Siemens City, eponymous with the big electronics company Siemens. It's where they have had their factories, headquarters, offices since the 20s, and where they have, and ultimately been the focal point for employment in the area. I mean, you're literally only 10 or 15 minutes away from, whether that be Potsdamer Platz or Mitte or Alexanderplatz, so it's exceptionally located with employment on your doorstep. We have got 10 exclusive units, which are from 187,000 euros roughly. And yeah, it's just another example of a product that is available to us today, which just wouldn't have been available pre-inflationary sort of period kicking off, because it would have just been snapped up locally. There are some restrictions with mortgages. Unfortunately, while the UAE, for example, or Nigeria is grey listed from a financial standpoint, you cannot get a mortgage if you're based, whatever nationality, if you're based in this country. I say this country, I'm in the UAE. But for anyone based outside those countries, there are some very, good options available. Do you want to take over now, Elliot?
So with the two London options, sort of leading London options that we have at the moment are Aspen, which is in Canary Wharf, so East London. Obviously, I'm sure most of you that are familiar with London will know of Canary Wharf, a fantastic development that is so all singing, all dancing, connected to a hotel, fantastic amenities for any purchaser. So we'll really interest and be popular for tenants, the finance people working within the area itself. Price points from about 550,000, and then we've got what I feel from a pure investment opportunity with Goldfinch Apartments in Hendon in North London, Northwest London. A really good London investment case from I mean, you're getting yields of up to 6%, as I say, which I've probably mentioned 3 or 4 times, but it genuinely is. It blows my mind slightly. I started working in the London market in 2008. We used to sell properties which we felt had good yields at 3%. So to saying that we've got London yields at 6%, it really is. It is fantastic, and then you get the capital appreciation. Area of regeneration next to a reservoir, overland and Northern Line connections into the city. So as does Aspen as well, we know fantastic communication links. And whenever looking at any investment in London, communication links are key. You have that nearby, and you will fail. You will not fail to let and have a successful purchase property there.
I think also the thing to highlight here as well is both of these products are off plan to varying degrees. Actually, Aspen has some units completing in queue towards the end of 2024 as well. depending on what floor you're on, but both of them have exceptional payment plans ultimately. 5% down on exchange for Aspen and 10% down for Goldfinch. So you can get into this for relatively little cash up front. Clearly, and this is part of the job that we will help you if you were to choose to come through us, as we obviously hope you do. It's very important to make sure that you can afford it on a basic level, and that and again, with all these products, we can offer detailed cash flow analysis, so you've got full visibility on how much money you need to put into things. We've already talked briefly about City Space, so I don't think we should dwell on that. Sorry, my printer's just started again out of the blue, so if you can hear that, I apologize. And then we've got Victoria Riverside in Manchester. Manchester's obviously been in the news for a long time. It's hell of a story, similar to Birmingham. People moving out of London, businesses moving out of London, looking for value. And again, this is the same developer as Aspen, a fantastic site, 10% down, completion at the beginning of 2025, 10% in 12 months, and very strong yields. This is the largest regeneration project, I think, in Europe. Did I read that correctly?
Yeah, this northwest. It's
absolutely vast. I mean, they're creating, over the next 20 years, they're effectively creating a whole district of Manchester, which will house sort of 40,000 people. So
exactly, it's a JV between the developer and Manchester City Council, which is this the whole sort of north-east block, which runs almost up to the from the city centre up to the ring road, where so the Etihad Stadium and that side of things is. So it's a huge project, but really quite exciting and interesting.
Sorry.
And then,
carry on, Elliot. Carry on.
Yeah, so Gleedles. Now, I'm sure many of you were either looking or bought properties 10, 15 years ago in the UK, and you might be saying that, and you're looking at prices, say, in the Birminghams and the Manchesters, and can't quite believe that you're now paying £340,000 for a 2-bed in Manchester, when 15 years ago you were able to buy a 2-bed for 170,000, 180,000. That price point is still attractive to many, and from an affordability, from a cash flow perspective, people like that. So we've had to look for other locations in the UK where we feel that, where you can find it, essentially. And Gleedles Wharf is an opportunity in Gainsborough that we found. It's a riverside project, fantastic views. Gainsborough is 20 miles or so from Sheffield, and Lincoln, equally equidistant from the two. So it sort of sits in that sort of Lincolnshire, Yorkshire, Derbyshire sort of border. Again, when you're looking from a tenant perspective in yields, we're looking at north of 6%. So that's a real opportunity. And you're getting 1-beds from £148,000. From the golfers' view out there, Ping European headquarters is based in Gainsborough. So you've got international companies realizing its potential in terms of an area and location. And so there is a lot going on with the city that we feel, the town that we feel gives a really strong investment case to get on that property ladder, or even add to your portfolio of sort of deposit levels of, say, looking at 30-40%, so 60,000 £60,000 as an investment sort of level. So Gainsborough is,
and actually worth noting that you'd only need, I say only, but you'd need 30,000 sort of now. It's I think the interesting thing with that is we've all seen what's happened with Manchester, with Birmingham, these Sheffield, these big cities, even Lincoln, right, which doesn't get as much press, but you can't buy products in equivalent product in these locations at these prices anymore. And so this is why, for us, we're always trying to offer a variety of options for our buyers, for our clients. This is something that in 10 years' time, those 1-beds, they will be 220, 240k. That's just what they will be, if not more. So Yeah, it's quite an exciting one. We've only just launched that last week. So if you would like to hear more about that, please do let us know. Elliot?
Birmingham, we've got our I'd probably say most popular flagship projects, which is the Scholars Quarter Copperworks trilogy. I think it's a trilogy. There's a third one. So the most recent Copperworks is about to launch as well. So very popular with a developer that we've worked very closely with for a number of years. Both one Copperworks is completed. So if you want a completed project where we've got tenants in situ, we're seeing that the rental returns are. This is a great opportunity. And then Scholars Quarter is completing between now and March next year, and a few units still available. If you want Jewellery Quarter in Birmingham at a good price point, a competitive price point, that sort of answers every question along the investment line in my view. You know, we've got completed opportunities there. We have nearing completion, so essentially built but waiting to complete, and then we have an off-plan option. And so you can, it's a very transparent purchase process and very transparent build process and everything else like that. Then having a chat with us about the Copperworks Scholars Quarter is a really good opportunity. Prices from about 240, I think now. 225 is one after.
And then the something a little bit different where we have, you know, this is houses. Obviously everyone likes a house, right? They like a garden. This is something that is not your sort of classic investor fare in many ways, but actually from a purely capital values increase point of view is probably something that will do best, or as well, if not better than anything else that we've shown you today, simply because there is such a demand for, you know, the most searched for thing on Rightmove is a 2-bed house, for example. So, you know, this is, you know, you're just over an hour from London, or an hour and, I think it's an hour and 17 minutes from London. Beautiful little market town. East Anglia is a lovely part of the world, and you can't buy houses at these levels close to London, basically. So again, slightly different opportunity, but again, options here which are handing over in the new year. So yeah, it's you know, they're beautiful, actually. They're fantastic. Then we've already talked about Goldstone, so we won't dwell on that. But if you're interested in the south of England and commute about to London, but you wanted at a more affordable price, then we've been doing a lot of work in Ashford, my hometown, actually, in Kent, and this is a development that is also coming up to completion, handover. Super, literally, you know, ticks every box. Half an hour on the train into London, affordable price points, overlooking a park, 5-minute, 6-minute walk from the station. You know, it's just a really, really solid option. So, Elliot, we've got a couple of questions. Oh, sorry, we've lost the presentation again. Yeah, so Wayne, I recognise your name. I think you've been on 1 or 2 of these with us in the past, so thank you very much for asking the question. So just asking the question around South African investors and mortgages in Germany. Unfortunately, at the moment, this is not possible, which is very frustrating, and something that came in the early part of this year. We've got a large South African client base, and so we'd love to be able to say that that is possible. The only way potentially around it is if you're able to demonstrate income in other locations, but even then, it's probably going to be tricky given your residency being South Africa. So I'm afraid that is a bit of a problem. Just something, actually, not that it, unfortunately, Wayne, not that it helps you particularly, but for UAE-based investors who are perhaps surprised to see UAE on that non-mortgage list, there was an article in the FT yesterday saying that they are moving, they're reviewing the UAE's grey list status, and they've made significant progress around AML and, you know, money laundering concerns and all those sorts of things that people, or that they've hitherto been worried about. And so we are hopeful that sort of potentially come Q1 next year that the UAE might be back on that list.
Yeah.
Do you want to talk a little bit about our services, and then we are just.
Yeah, I think there was just one other question. Yeah, so I think there's just one other question there, Richard. From Jonathan. So if he says, if you had an investment of £70,000, which project would you choose?
The classic question. I think with £70,000, you need to be guided by a budget, right? I think that's the most important thing. It's fine to aspire to own property to live in and, you know, potentially push yourself to do that. But if you're investing, the last thing you need to do is buy something where it's stretching you and you're lying awake at night worrying about making payments, making mortgage payments, all that sort of stuff. With that price point, I particularly like the Gleddles Wharf product, because you could be, as you said just now, you could be in and out on a 2-bed for £70,000. You know, with potentially sort of £40,000, £40,000 down now. So you know, I think that would be something that could potentially answer that question. But again, it does depend. You know, it might be that, you know, we have clients, don't we, who would put, you know, 50, 60, £70,000 down on something as a deposit, but because there's cash flow coming through, whether that's however that is, whether it's sale of other assets or a bonus, whatever it might be, or just pure savings, might be that they could actually end up buying something a bit more expensively and still be comfortable with that decision. Yeah,
exactly. £70,000 today, but then you could look at something off plan, and then let's say you think in 2 years' time you may be able to save another £30,000 to £40,000, you know, and you're north of that £100,000 mark. Just opens you up to quite a few more options as well. I think that's sort of where
well, certainly. I mean, I mean, obviously, Gleddles Wharf there on the river, with the marina being built, with the, you know, the investment they've got going in there, that you just cannot buy property at that price point very easily anymore in the UK. You know, so not new build property because of construction prices, but land prices, all that sort of stuff. So we are in a situation now where, you know, that it might be a small town, but there's a lot going on there, and it's close to larger places, and so logically speaking, there is a significant upside from a capital value perspective over the next 5-10 years.
Yeah, exactly. Yeah, agreed. Thank you very much, Jonathan. Right, so just to quickly running, I appreciate we're sort of working on here with time. So just so you're aware of our services. So the research and due diligence, that element happens with our team in the UK. We offer sort of a residential advisory business that work with developers from the outset, from planning to funding to purchasing sites and that side of things. We then also have once we've done that work with the developers, we'll start representing them overseas, and obviously offering them to the likes of yourselves or on here, where we can offer that investment advice. We can look through cash flows, locations, why it's right for you, if it does fit your budget criteria, and everything along those lines. Once you've decided to move through that process, we obviously then help on the conveyancing side. We have partners from mortgages who will advise you from your lending and your lending criterias, and then ultimately the property will be handed over in your ownership. You physically don't need to be with the property and physically receive the keys and everything else like that. Our lettings and property management guys in the UK that go under the name of our sister company Brick will be there on hand to manage and service all things real estate in terms of your ownership of that property, whether it be finding the tenants, furnishing the property, ensuring the rent's paid on time, maintenance, and everything else along those lines. And finally, you know, as and when the time is right for you and you'd like to exit and sell the property, we can also help with that at the far end, whenever that time may be, with the guys based in the UK, or even us based here, looking at for the similar investors that are looking for an opportunity. So essentially an end-to-end service where we've got touch points at every point along the way.
Yeah. Well, look, thank you very much, everybody, for your time. Elliot, thank you as well. we obviously the whole idea behind this is that we can provide an advisory service. There's a range of product there. There's other products outside of that, but in the end, those are the key ones that we're working on at the moment, where we are comfortable with the DD, and we are comfortable that in the end, you as a potential customer or buyer through us will make a set, by buying one of those things, you're making a sensible decision ultimately. And yeah, as I say, thank you very much. We will reach out to you following this, and it would be lovely to chat to you one-on-one and answer any further questions that you have. But yeah, as I say, thank you, and we will catch you again next time.
Yeah, thank you, everyone.
Cheers. Thank you, Elliot. Bye-bye.